Welcome back to the desk. I'm Alex, and today we are discussing tax reporting obligations of crypto firms registered in Ireland. If you like this type of content, please subscribe to our channel. Treating the crypto asset reporting framework like it's just a minor update to legacy tax rules creates massive operational risk. Historically, the common reporting standard allowed platforms to rely on simple account balances recorded at the end of the fiscal year. CARF changes that requirement, demanding the dynamic, real-time logging of every individual microtransaction. This includes capturing every token swap, routing every network airdrop, and tracking exact staking reward values. These events must be identified and structured at the precise millisecond of execution, rather than being batch processed at year-end. This shift requires a total back-end overhaul, embedding compliance directly into the core data engineering pipeline. The Irish Revenue Commissioners have officially codified these strict new requirements into law. Ireland's Taxes Consolidation Act now explicitly dictates that the CARF XML schema must serve as the foundation of your reporting structure. This architectural overhaul must be fully functional and tested before the start of the next calendar year. Missing this implementation window triggers immediate revenue audits and significant reputational damage, as non-compliant user accounts face mandatory freezes. Surviving 2026 requires a systematic reconstruction of the data pipeline, starting with a precise definition of which entities are in scope. The first step is identifying your status as a reporting crypto asset service provider, or RCASP. This hierarchy serves as a rigid geographic filter. In Ireland, classification is determined by specific operational triggers. Tax residency triggers automatic inclusion. The scope also captures entities incorporated, managed, or maintaining a primary place of business here. Decentralized finance protocols lack automatic immunity. The legal trigger centers on control or sufficient influence. If an entity exercises either over the protocol, they hold full liability for reporting. Corporate structuring and technological decentralization cannot shield an operation if its operational influence traces back to an Irish nexus. Onboarding now mandates the active verification of user self-certifications. Platforms must cross-reference incoming self-certifications against anti-money laundering and KYC databases to prove reasonableness. Providing a French tax identification number alongside a Dublin residential AML address creates a geographic conflict. This immediately triggers an automated system-level hard stop on the user's account. This block must remain in place until the user provides a documented explanation for the discrepancy. Automating this choke point is essential. Without it, routine onboarding errors become systemic compliance violations. The same scrutiny applies to your platform's historical user database. Platforms must retroactively apply these AML cross-referencing checks to every active legacy client. A 12-month remediation window begins in January 2026 to resolve all existing database conflicts. If legacy clients cannot be verified within that window, the platform is legally required to permanently lock them out of future transactions. Existing market share is a significant liability if the underlying data hygiene is structurally flawed. The final stage of the pipeline involves pricing decentralized assets for official reporting. This hierarchy assigns a fiat value to every transaction at execution. Platforms must first prioritize internal crypto-to-fiat trading pairs. If unavailable, the system cascades down to internal accounting book values and then to reliable third-party aggregators. The structure strictly forbids rough math or casual guesswork. Using a reasonable estimate is strictly forbidden unless it is meticulously documented as the absolute last resort. Failure to automate this valuation hierarchy results in invalid fiat conversions, causing an immediate failure of the XML schema requirements. This transition replaces passive balance tracking with a real-time, for-stage logging pipeline. The architecture integrates the Nexus scope filter, the AML validation block, and the 5-tier pricing engine into a single output for the required XML schema. Mandatory data collection begins on January 1, 2026. By December 31, 2026, Every platform must formally register its CARF status on the Revenue Online service. The first annual return is due to both the Revenue Commissioners and your users by May 31, 2027. The window for back-end software development is closing rapidly as the 2026 deadline approaches. Outsourcing this pipeline to a third-party vendor does not absolve the Executive Board of liability if the system fails. Even technically perfect code fails if the surrounding operational oversight is weak. If you're interested in the crypto world, please see the next video we have chosen for you. In this video, we examine the Central Bank of Ireland AML CFT enforcement action against Coinbase, and if you like these videos, please subscribe.